Jerome refreshes his brokerage app for the fourth time in 90 seconds. It's Friday morning, and the ticker finally goes live. And there it is, SPCX. It climbs to $170, then $180, then $200. He's waited 18 months for this, the chance to finally own a piece of the company that lands orbital rockets like it's parallel parking a Honda Civic. So he does what every true believer does. He hits buy at $206 a share. He feels like he's getting in early, but here is what nobody told Jerome. The people who sold him those shares at $206 bought them the exact same day or the day before for $135. Same company, same rockets, $71 cheaper, just hours earlier. Jerome didn't get in early. He got in last, and he paid a massive premium for the privilege. This isn't a script about whether SpaceX is a great company. It obviously is. This is about the gap between a great company and a sane price, and why those two things almost never show up on the same morning. And I spend an unreasonable amount of my life thinking about why smart people lose money on exciting things. If you've ever watched a stock you love rip higher and felt that itch to just buy it already, do me a favor and hit subscribe. Today, we are running the actual math on the biggest IPO in human history. We are going to figure out what it would take for buying it today to be anything other than a very, very expensive feeling. The mechanics of the largest IPO in history. Before we go any further, let me stop the comments section before they start typing. I am not here to tell you SpaceX is a bad company. They turned rocket launches from a historical national event into a random Tuesday. None of that is in question. And disclaimer, I'm not a financial advisor. I'm just a guy who's watched this exact movie play out a dozen times, telling you how it usually ends. Here's the thing about initial public offerings, IPOs, that the confetti and the countdown clocks are heavily designed to make you forget. An IPO is not built to get you a good deal. It is built to get the people who already own the thing the best possible price for selling it to you. That's the whole event. Keep that in your back pocket for the rest of this video. So let's talk about what actually happened, because the scale of this SpaceX IPO is genuinely hard to wrap your head around. On June 11th, SpaceX priced its IPO at $135 a share. It sold around 555 million shares and raised $75 billion. Then, the underwriters exercised the green shoe, basically a bonus round where they sell even more, and the total climbed to about $85.7 billion. That makes this the largest IPO in human history. It blew past Saudi Aramco, which held the record at $29 billion. SpaceX nearly tripled it. The valuation they slapped on the whole company? $1.77 trillion, with a T. That number alone makes SpaceX, on day one of the 6 most valuable companies in the entire United States. It is sitting in the exact same weight class as Apple, Microsoft, and NVIDIA, companies that have been printing cold, hard cash for decades. Then the stock did what hype stocks do. It opened, it popped, and within a couple of days, it was trading north of $200 a share, which is great news if you're an insider who got in at $135. It's a slightly different story if you are Jerome. The reality check: revenue versus hype. Here is where the math gets incredibly interesting. Let's look at what you are actually buying for $1.77 trillion. In 2025, SpaceX did about $18.7 billion in revenue. That's real. It's growing, and it's deeply impressive for a company that builds space hardware. But it also lost money. On a standard accounting basis, SpaceX lost about $4.9 billion last year. And since it was founded back in 2002, it has racked up a cumulative deficit of somewhere around $41 billion. So, You've got a company that, despite tremendous technological success, has spent most of its history prioritizing growth over generating consistent annual profits, and it's being valued at one of the highest price tags ever assigned to a human enterprise. Let me put that valuation in terms that actually mean something to an investor. When you pay $1.77 trillion for $18.7 billion in sales, you are paying roughly 94 times revenue, not earnings, revenue, the total amount of money that comes in the door before a single bill is paid. To give you a reference point, the most expensive big stock in the S&P 500 before this was Palantir, trading at around 73 times sales. And Wall Street loses its mind over how rich that is. The average company in the S&P 500, it trades at around 3 times sales. 3. SpaceX came public at 94, and after the pop, it's trading north of 100. You are not paying for the business SpaceX is. You are paying for the business it might become if absolutely everything goes right for the next decade. Now, to be fair, the bulls aren't crazy. If Starlink becomes the dominant global satellite internet network, if Starship dramatically lowers the cost of getting things into orbit, and if they keep winning massive defense contracts, today's valuation could end up looking reasonable in hindsight. That is the bet. The question isn't whether SpaceX can do amazing things. The question is how much of those amazing things are already reflected in the price investors are paying today. The sneaky mechanics, scarcity, and governance. When you buy SpaceX, you're mostly buying Starlink. That's the part making real money. Over 10 million subscribers with margins that look more like a SaaS software company than a rocket builder. The rockets are the show. Starlink pays the bills. But that $1.77 trillion price tag requires every single division to hit a home run. But here's the part that makes this IPO genuinely sneaky. SpaceX only floated about 4% of the company to the public. 4%. They kept the other 96% locked up tight. Why? It's simple. Supply and demand. When there are very few shares available and a whole planet of people who want them, the price goes up. You've created a stampede through a single doorway. And because SpaceX is so enormous, it automatically qualifies to be added to big stock indexes like the NASDAQ 100. When a stock joins an index, every mutual fund and ETF that tracks that index is forced to buy it. They don't get to say, 94 times sales is too rich for my blood. They have to buy it. So you have billions of dollars of blind, automatic buying flooding into an already tiny supply of shares. That props the price up artificially. It masks the reckoning. It doesn't cancel it. Now let's talk about who is actually steering the ship. SpaceX came public with a dual-class share structure. The shares you and Jerome buy get 1 vote each. The shares Elon Musk holds get 10 votes each. Added up, and Musk controls 82 to 85% of the voting power. In plain English, you are not a part owner with a voice. You are a passenger who paid a ticket. Musk can do essentially whatever he wants, pour billions into his AI ventures or pivot the company entirely, and there is no shareholder vote that can stop him. At this price, you aren't just paying for a rocket company. You are paying a $1 trillion premium for one specific human being's attention, a human who is also running Tesla, XAI, X, and moonlighting in politics. Market history. Why hype hurts. Let's zoom out. What usually happens when a wildly hyped company goes public and regular retail investors pile in? Jay Ritter, a finance professor at the University of Florida, is basically the world's leading librarian of IPO data. He's tracked thousands of these. His data paints a brutal picture. On average, IPOs underperformed the broader market over the years following their debut. The exciting ones, the expensive, low float, everybody's talking about it ones, tend to do the worst. You don't need academic data to feel this. You've watched it happen. Facebook went public in 2012 to massive hype, then fell 54% over the next few months. Rivian, the electric truck company everyone loved, fell 95% from its peak. Coinbase dropped 90%. Robinhood dropped 92%. These weren't obscure scams. These were beloved "this is the future" companies. And the people who got hurt the most were the ones who bought on day one because they couldn't stand the idea of missing out. Now, the SpaceX bulls will throw one word at you: Tesla. Tesla went public in 2010 and is up something like 20,000%. If you bought the IPO and held, you're rich. But here is the asterisk. To capture that 20,000%, you had to survive a ride that included the stock dropping more than 60% at one point, plus several other 30% gut punches. Most human beings do not hold through a 60% loss when the media is telling you them a company is doomed. They sell at the bottom. Are you emotionally prepared to watch your SpaceX investment get cut in half twice without flinching? Conclusion: patience as a strategy. Which brings us back to the core idea of this video. A great company and a good stock are not the same thing. Confusing them is one of the most expensive mistakes in all of investing. Facebook in 2012 was a fantastic company. Buying Facebook stock on IPO day was a bad financial decision. The patient investor who waited 15 months got the exact same wonderful company for roughly half the price. SpaceX has a built-in reason to expect this exact pattern. Remember that 96% of shares that are locked up? That lockup doesn't last forever. Over the coming months, in waves, early investors and insiders are going to be allowed to start selling. When a flood of new shares hits the market, the artificial scarcity vanishes. The doorway gets wider, the stampede slows down, and the price tends to sag. So let me talk to you, Jerome. Let me talk to everyone who feels that pull right now. You watch this company catch a 200-foot rocket out of the sky with a giant pair of robotic chopsticks. You feel in your gut that this is the future and you want to own a piece of it. That instinct is correct. Loving the company is not the mistake. The mistake is letting that love walk you into paying any price at all. The underwriting machine, the index funds, the thin float, that entire system is engineered to convert your genuine excitement into the worst entry price available. Your enthusiasm is the product, and they are selling it back to you at a massive markup. You are allowed to love a company and not buy it today. You are allowed to be fully convinced SpaceX is going to Mars and still say, "Great, I'll wait for a price that isn't mathematically insane." Watching is a position. Not yet is a strategy. You can dollar cost average over time. You can wait for the lockups to clear. Or you can buy a low-cost index fund that automatically owns a slice of SpaceX for you without paying the day-one tourist tax. There is no trophy for buying first. There's no medal for catching the absolute top of the pop. The prize in investing goes to the person who is still standing, still calm, and still buying good things at fair prices long after everyone else has moved on to the next shiny rocket. Let the confetti settle before you decide it's a party worth paying for. If this helped you think a little more clearly today, hit the like button, subscribe, and check out the links below. I'll see you on the next one.